So let's continue. Take one question. Let me explain first. Wait. Before going to the question, wait. Let me explain this thing, the logic behind this. See, what was the question? A person wants to receive 1 lakh every year, correct? Starting from the end of the first year for 4 years. Now think, there is an investment where you want 1 lakh. You want to invest something and you want 1 lakh for next 4 years. Okay. So what is the amount you should deposit today? And that amount is this, 3,16,970. If you deposit 3,16,970, okay, then you will get 3,16,970. If you deposit, then you will get, okay, 1 lakh, 1 lakh, 1 lakh for next 4 years. Okay, let me prove this. See, 0th year you deposited, please give me the answer, how much it is? 3 lakh. Yes, anyone? 980. This is the amount what you deposited. Okay. So this is the amount you are making a deposit and you want 1 lakh, 1 lakh, 1 lakh for next 4 years. So when you deposit this amount in the first year, after 1 year, you will get 10% on that. Correct? 10% was the interest rate. So take this on your calculator, plus 10%. Take this on your calculator, plus 10%. 3,16,980 plus 10%. How much it is? 3,48,678. This is what you have got in your account. This is the accumulated amount. Out of that, you are withdrawing 1 lakh. So the leftover is 2,48,678. Correct? In second year, again you will get 10% on this amount, 2 lakh. So plus 10%, 2,48,678. Take on your calculator, plus 10%, 2,73,546. Out of that, you will withdraw 1 lakh. You want 1 lakh at the end of second year. So leftover is 1,73,546. On this, you will get again 10% plus 10%. 1,73,546 plus 10%. How much? 1 lakh 900. On this, from this, you will remove 1 lakh. You will withdraw 1 lakh. So 90,900 is left. Okay. In fourth year, again you will get 10% on 90,900. 90,900 plus 10% will be approximately 1 lakh. Check. You will withdraw 1 lakh from your account. How much you have left over? With 0. The scheme is done. Yes, 99,900 means that only, na? Means 1 lakh. Yeah, 990. That is 1 lakh. Is it clear? Understood? So this is how you should have the grip on the sum. Okay. Okay. Fine. Take one question. I hope everybody has understood this. Yeah. Any question? Query on this? Which property? Second property means, yeah, the same second property I said, whenever you will be applying this formula, this factor what you get, and when you multiply this factor with this annual cash flow, the value what you get will be 1 year back from the date of first installment. When was your first installment? First year. Your first installment was first year. So 1 year back means you will get value on the 0th year. That is what the formula said. Means that is the property of the formula. Okay. Yeah. Total amount. 1 year back from the date of first installment. To clear that, I am giving you this sum. Right. A person wants to receive rupees 1 lakh each year for 4 years, starting from end of third year. Let me check. A person wants to receive rupees 1 lakh each year for 4 years, starting from end of the third year. Full stop. How much? he should deposit today if interest rate is 10% per annum. I'm giving you 5 minutes. Please do it. How I would solve this sum? No need to write and all. Actually, you can do this on your calculator. Okay. 10% is the interest rate. If I make this timeline, it should be clear. Here, cash flow 1, 2, 3. I will write from 0. So 0, 1, 2, 3, 4. See, a person wants to receive 1 lakh each year for 4 years. Correct, starting from the end of the third year. So 1 lakh, 1 lakh, 1 lakh, 1 lakh for 4 years. Correct. I'm directly applying the formula. I'm not making a table. Okay. So I want present value. Is it a sum of annuity? Yes. So first I will apply PVIFA. First I will apply PVIFA. 10%, comma 4 installments. So 1 minus 1 plus I raised to minus n upon I. So 1 minus 1.1 raised to minus 4 upon 0.1. Correct. How I will solve this on my calculator. 1.1 divide equals to 4 times and GT. Those who don't have GT, I have given you the steps. You know 1.1 divide equals to 4 times and then minus 1 and then divide by 0.1. Answer is how much? Factor is how much? 3.1698. So this is the factor. Now, okay, value at the end of, now value when I will multiply, value at the end of second year I will get. Value at the end of 1 year back from the date of first installment. 1 year back from the date of first installment. So I will get the value when I will multiply 1 lakh with PVIFA factor 3.1698. Therefore, you should know the rules, the basic properties. So this is value at the end of second year, but I want present value. So I will apply present value factor 3,16,980 into 1 plus I, that is 0.1 raised to how many years back I have to pull? 2 years. So raised to minus 2. Obviously I can do this on my calculator. Right? Please give me the answer for this. 1.1 divide equals to, again equals to 1.1 divide 2 times equals to, then multiply by 3,16,980. Answer is what? 2,61,958. This is the present value. Everybody understood? Is it clear? Now it should be clear what is the property. N should be number of installment and it will give us value 1 year back from the date of first installment. Some people now they will directly apply this formula, and when applying the formula, what they will do? They will take 6 years. No, it will be wrong. Is that clear? Understood? Okay. So I think this time it should be Aditya, it should be clear what we are saying. Right now, it gives us value 1 year back. Then again you have to pull it back by single cash flow formula. Okay, please copy. Okay, done. Okay, right. Write the heading. Uneven cash flow. Uneven cash flow. Yes. Hmm. 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 Yeah, we can prepare. Uh, uh, yeah, obviously. Yes, yes. Yeah, yeah, yeah. No problem. See, what you should do is you should multiply. I'm just telling you, those who want to do it. 1.1 raised to minus 3, 1.1 raised to minus 4, 1.1 raised to minus 5, 1.1 raised to minus 6. Done now. I pulled this using 3 years back. Correct? Done. That's it. Okay? Chalo. Is it clear? Fine. Uneven cash flow. Right. different cash flows every year. Different cash flows every year. Example, a person wants to receive rupees 10,000, wants to receive rupees 10,000, semicolon, rupees 20,000, semicolon, rupees 30,000, semicolon, rupees 40,000, semicolon, rupees 50,000. respectively from year 1 to 5. From year 1 to 5. From year 1 to 5. Calculate present value if interest rate is calculate present value if interest rate is 10% per annum. Calculate present value if interest rate is 10% per annum. Everybody copied? Can you apply the formula here? Annuity formula. A person wants to receive 10,000 at first year end, 20,000 second year end, 30,000 third year end, 40,000 fourth year end, 50,000 fifth year end. You can't apply the formula, correct? You can't apply the formula. So solution will be, we will have to make a table. No, there is no option. Here, cash flow, discounting factor at the rate 10%, present value. Please be careful. All the sums in capital budgeting will be like this. Please be careful what I am solving. 1, 2, 3, 4, 5. First year in 10,000, second year 20,000, third year 30,000, fourth year 40,000, and then 50,000. Correct? Okay. 1.1 divide equals to, how you will get discounting factor? 1.1 divide equals to 0.9090. 1.1. Why 1.1? Because 10% was interest rate. Why divide? We are calculating present value. Equals to, you will get this factor. Again equals to 0.8264. Again equals to 0.7513. Check. Again equals to 0.6830. Again equals to 0.6. How much? 6209. Understood? Multiply this and take the total. That will be a present value. I hope everyone, the sum is clear. After doing annuity, this should be a very cakewalk for you. Okay, this is very easy sum. Fine. Easy. Everybody understood? I have to calculate the present value. So I have used the discounting factor. Okay, I have pulled it back. Right now, what I didn't do anything new. Here I multiplied with 1.1 minus 1. Here 1.1 raised to minus 2. 1.1 raised to minus 3. 1.1 raised to minus 4. 1.1 raised to minus 5. I just didn't write it. That's it. Understood? Okay, please copy and give me the answer. And when you multiply this, you should use m plus. When you multiply, you should use m plus. You should make habit of this. And then you should take MRC after adding all. Please do this, complete this. Okay. Can anybody confirm? 1,06,552. Correct, na? I don't have the solution. Okay, okay. Fine. Please copy. 522. Okay, okay, okay. No problem. 522. 1,06,522. Complete this. Okay, done. Okay. Okay, let's start with the new chapter. Write the heading, name, investment decision. Yeah, before that, I have given you 75 sums of TVM. If you want to practice, you can practice it at your own. Okay, but it is not going to come in your exam. Sorry. Yeah, I will send you if you want. I'll give you the answer keys. Means what is the homework part that I don't have, but what is the classwork that for that I have. Okay, so you can practice it. Yes, 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 sure. Okay. Right, investment decision. Before proceeding to the chapter, overall what we are going to learn in FM, let us understand that. See, this is balance sheet. Okay. So here there are fixed assets or non-current assets, what you call. Fine. So generally what happens, whether to buy a machine or not. Okay, I'm just giving you an overview what we are going to learn in FM. So whether to buy a machine or not, that is a decision of investment. Correct now? So whether to take up a project or not, that is a decision of investment. So all this gets covered in investment decision, which is the next chapter I'm going to teach you. Right? After this, what you have is sources of finance. Means what are the sources from where you can raise, that is liability side. Correct? Sources. What is equity, different type of equity? What are commercial papers, commercial deposits? What are treasury bills? What are different types of bonds? What are different type of debentures? All those things. Okay. So ultimately we are studying about liability. Then you have one chapter on working capital. What is working capital? Current asset minus current liability. In simple terms, I'm just giving you the overview. Once again, it's related to balance sheet. Correct. Next is long-term financing decision. That is whether you should go for equity or you should go for debt or you should go for combination of that. Correct. That is called long-term financing decision. Again, it's related to balance sheet. Then you have ratio. Ratio again is dependent. Ratio is calculated on income statement or on the balance sheet or using both the items. Means items from one from income statement, another from balance sheet. Okay. So ultimately it is also related to balance sheet. Means you are analyzing the company. Then there is dividend decision, whether the company should declare the dividend or it should not declare the dividend. So I have given you overall view. So ultimately what I mean to say is we are moving around the balance sheet in interlevel. Okay. So we are ultimately studying about the balance sheet overall. Okay. So let's start. Investment decision. I'll give you the before starting, write one overview. What we are going to do. Write that. So in investment decision, what we are going to learn. I have divided the chapter into two parts. One is basic and another one is advanced. Okay, where we are going to apply the things. So in basic, we have to learn the techniques. So let us list down the techniques, what we are going to learn. One is payback period. This is the overview. One is payback period. The next is Rate of return on investment. Rate of return on investment. Rate of return on investment. Then you have average rate of return. Average rate of return. Please write. Then you have net present value. Net present value, NPV. Net present value. Then you have profitability index. Profitability index. In one exam, in recent exam, I remember they asked it as desirability factor index, desirability index, not factor, desirability index. Or they also called benefit index. They also call it benefit index. They also call it benefit index. They also call it present value index. So you should know all the names. In one exam, it happened that student didn't know the name and they couldn't solve, but it was very easy. Payback period, rate of return on investment, average rate of return, net present value. Then one more you write IRR, internal rate of return. One more you write IRR. One more you write discounted payback period. Discounted payback period. Discounted payback period. One more you write annualization of NPV. Annualization of NPV or capitalization of NPV. Capitalization of NPV. So this is also one of the methods. So in all, how many methods I have given you? 1, 2, 3, 4, 5, 6, 7, 8 methods. So these are the 8 techniques. This we will apply in the advanced level. So these are the 8 things which you should be able to calculate. Okay. They have their own drawbacks. They have their own advantages. And we should be thorough with that. It's theoretical question. So you should know this. Okay. So he said modified IRR. That is also one of the technique, but it is not asked. Or you can write that also. One more thing, modified IRR, MIRR. MIRR. Obviously, I cover that in the last lecture when I will be finishing FM. These are the miscellaneous topic. It was asked only once in CA final. That is in I think 2015 or something. MIRR. It's a technique, but it is not useful. Means you can't apply it in the exam. Apply in the sense you can't apply in the exam. They don't ask you because they don't know whether you know that trick. I taught you that root wala trick, 12 times root and all. That is applicable. So they don't ask you. If you want, you can write MIRR. Okay. So these are the techniques. The first one is very easy. Payback period. Write the heading. Payback period. Now I have directly started with the chapter. Okay. See, what we are trying to do is we are trying to analyze whether the investment should be done or whether the investment should not be done. Okay. So these are the techniques which will be used to analyze whether you should take up with the project or whether you should buy the machine or not. So as I said, every technique has its own drawbacks as well as advantages. Fine. So before moving into payback period, I want to teach you something which is called as how to calculate the annual cash flow. What I want to teach you? Annual cash flow. So write under that annual cash flow. Annual cash flow. In the exam, PBDT will be given. What is PBDT? profit before depreciation and tax, that amount will be given, minus you will do depreciation. What you will get? PBT. From that you will minus the tax. What you will get? PAT, profit after tax, correct? Okay, then in that PAT you will add depreciation. What you will add? Depreciation. So what you will get is called annual cash flow, ACF, annual cash flow. Okay, now what I want to ask you is why I deducted the depreciation and then I again added back. It's a non-cash expense, that is first thing. So when I charge salary to my PNL, salary is gone, correct? You have used the salary is what I should say, the salary is being paid in cash, but when I charge a depreciation to PNL, okay, at that time depreciation means it's a non-cash expense, so it should be added back. One thing, someone said that depreciation is a tax deductible, okay, so therefore it should be deducted before taking the tax, calculating the tax. Understood? See, I will give you one example. Now math student, they will feel that sir, minus and plus ultimately it should become 0, no need to take. No, it is not like that, because tax is in percentage, so it will impact you. See, if my PBDT is 1 lakh, let's say it is 1 lakh, okay, my depreciation is 20,000, okay, fine. So if I minus this 20,000, my PBT is 80,000. On that 40% will be how much? Tax. 4 8s are 32,000. Minus 32,000. 80,000 minus 32. How much? 48,000. If I add the depreciation, depreciation is 20,000. So my cash flow is how much? 68,000. Correct? Now those who are applying maths now, minus plus, they will think that it is 1 lakh. I will not take depreciation. So my PBT will be 1 lakh. On that 40% will be 40,000. Correct? 40% will be 40,000. Then it will be 60,000. Okay. And when I will not add the depreciation, I will not take here also, not take here also. The cash flow is coming 60,000. Is it correct? No. Are you understanding, guys? What I want you to understand is, please remember here, because of this depreciation, my tax got reduced. My tax got reduced by 32,000. Yes or no? My tax got reduced by 8,000. Yes or no? If it was, yes, listen, yeah, instead of this, see, because of this depreciation, I saved the tax. I saved the tax by how much? By 8,000. Otherwise it would have been 40,000. Correct? Now it is 32,000. Right now, so I have saved it. So what I mean to say is, now someone was asking, sir, only depreciation is deducted. All the non-cash expenses are deducted. Depreciation, amortization and all. Is that clear? Tax deductible expenses should be deducted. Please listen carefully. Tax deductible expenses should be deducted first. You should calculate the tax. Non-cash expenses should be added back. That's it. Understood? I can't make a list of the things that what you should minus and what you should add. Okay, but the concept should be clear. What? You should minus all the tax deductible expense before calculating the tax, and you should add back all the non-cash expenses. Okay, so is it clear? Now this part. Yes. Which annual cash flow? Company's annual cash flow I'm talking about. Yes. See, 1 lakh was my profit before depreciation and tax. Out of that, I will deduct 20,000 my depreciation. Okay. So from the project, what I earned before depreciation was 1 lakh. From the project, what I am getting, annual cash flow is 68,000. So I am trying to calculate the annual cash flow of the project. I am trying to calculate annual cash flow of the project. Is it clear now? I don't know what you are not understanding. Means what you are asking for. His question is why you will add back the depreciation. Why you will add back the depreciation? It's a non-cash expense. Listen carefully. I said that when I pay the salary and I debit in P&L, salary goes, cash flow gets reduced. So please understand, this is my profit, but actually my cash box will not have this amount. My cash box will not have 48,000. The cash box will have more. Are you understanding? More by what? More by non-cash expense. Let me clear it once again. If a company has a profit, see, one is profit, that is accounting profit, one is cash box. Correct? In your accounting profit, the accounting profit is 48. Correct? When you got that 48, after deducting 20,000, now tell me that 20,000 depreciation, have you paid it? No, that means more cash should be available. So you are adding it back. Is it clear? Great. Chalo. Is it clear? Very good question. Now next, listen. One more thing. One more method to do this, annual cash flow. We are talking, when I am saying annual cash flow, I am talking about the project. Let's go slow. Okay, first understand the calculations, how to apply and all is the second part. Second method is PBDT minus tax. Okay. And then add the tax shield on depreciation. Tax shield on depreciation. And then you get the annual cash flow. See, I will explain what I mean to say. 1 lakh was my PBDT. This is another method. On 1 lakh, I will calculate 40%. That comes to how much? 40,000. So I have left over with 60,000. Please understand. This is just a method. You are not going to pay 40%. Okay, 40,000, 40%, 40,000 tax. This is just a method. Tax shield means what? Whenever you calculate tax shield, how much was a depreciation? Depreciation amount was how much? 20,000. Tax shield means tax savings. On that 20,000, I saved 40%. I saved how much? 40%. That comes to 8,000. So 60,000 plus 8,000. My annual cash flow should be 68,000. That is same. This is another method. Is that clear? I generally prefer method 1. I never prefer method 2. Is it clear, guys? Okay. So method 1 is very convenient. Okay. Any doubt till here? Please copy this. Copy this. Next. So both the methods, any of the methods can be applied. Okay. But I will be preferring method 1. So I think now it is clear that depreciation should be deducted because it's a tax deductible, right? Because it's an expense on which the tax get reduced. So you should reduce it before applying the tax. And second thing, it's a non-cash expense because cash is not gone anywhere. So you should add it back to get the annual cash flow. Okay. Next. Coming back to payback period. Now in payback period, there are two types of sums. In payback period, there are two types. Type 1 and type 2. Type 1 and type 2. When the annual cash flow is even, type 1 is when the annual cash flow is even, and type 2 is annual cash flow is uneven. When the annual cash flow is even and annual cash flow is uneven. I hope now it should be very clear what is even cash flow and what is uneven cash flow. Right? Even means what? Even means what? Same cash flow. Yeah, equal. Same cash flow every year. Uneven means what? Different cash flows. Okay. Now, here you will apply formula. And here you will apply cumulative. Here you will take cumulative. Okay. What I mean to say, I will explain. Please go on writing. Take the notes. Formula. Payback period is equals to original investment upon annual cash flow. Original investment upon annual cash flow. Payback period is equals to original investment upon annual cash flow. Take one example. Original investment is equals to rupees 10 lakhs. Depreciation is equals to straight line method, SLM, straight line method. Life is equals to 5 years. Tax rate equals to 40%. PBDT is equals to 5 lakhs. PBDT is equals to 5 lakhs. Calculate payback period. Calculate payback period. Listen carefully. One of the easiest method. But what happened when the new syllabus was introduced now? Student used to always think, this is the very easiest method. They will never ask. But there was a question on this. And they asked a very good question. Okay. So please concentrate. Solution will be the step 1. See. Please write here PBDT per annum. PBDT per annum. Please write PBDT per annum. PBDT per annum. Now listen carefully. When we have to calculate annual cash flow, if the PBDT per annum is same, okay, and depreciation for every year is same, okay, then you can do vertical method. What I mean by vertical method, in single column you will get annual cash flow. What I mean to say, listen, think. If PBDT for all the 5 years is same, the project is going to be for 5 years. So every year the PBDT will be same. Now there is a project where the original investment is 10 lakhs. Okay. The company follows straight line method and the life of the project is 5 years. And tax rate applicable to the company is 40%. The company's PBDT will be 5 lakhs. Every year it will be 5 lakhs. Now you think, imagine if PBDT for every year is same, if depreciation for every year is same, tell me, under straight line method, depreciation will be same, na? Yes or no? Every year it will be same. Whether the PBT will be same for all the 5 years? Yes. On that tax is 40%, so that will also be same. If tax is same, means PAT is same. Correct. And if I add the same depreciation every year, that means ACF is same. So why you will calculate it for 5 years? You will do only one calculation. See what I mean to say. Working note number 1. Because I have to calculate depreciation, ACF, I will calculate first depreciation. Calculation of depreciation. Original cost minus salvage value. Original cost minus salvage value upon life. Correct? So original cost is how much? Original cost is 10 lakhs. Was there any information about the salvage value? No, therefore it will be 0. How much was the life of the project? 5 years. So how much is the depreciation? 2 lakh per annum. Correct? 2 lakh per annum. So working note number 2. Second thing I will have to do is I will have to calculate the annual cash flow. Calculation of annual cash flow. Why, sir, you are doing all this thing? See, you should have that intuitions. You should understand this thing. Original investment is 10 lakhs. Right? Depreciation is same. PBDT is same. Understood? If PBDT is same, straight line method means depreciation is same, means every year's annual cash flow is same. That means it's a even cash flow sum. When it's even cash flow sum, you have to apply what? Formula. And what is the formula? Original investment upon ACF. I have the original investment. Understood? I should calculate what? ACF. To calculate ACF, I should know the depreciation. Is that clear? Yes or no? Yes. So listen, working note number 2, annual cash flow, year 1 to 5. Year 1 to 5. PBDT is 5 lakhs minus depreciation is how much? 2 lakhs. Correct. And PBT is how much? 3 lakhs. Right? Tax rate was how much? 40%. So 40% of 3 lakhs is how much? 1 lakh 20. You have to be quick. Maintain your speed. 1 lakh 80,000. Very good. What I will add back? 2 lakh. That is depreciation. Non-cash expense. 2 lakh. So company's cash flow is how much? 3 lakh 80,000. This is my ACF. Annual cash flow. Correct. Now the third part. Working note number 3 or the main part. That is computation of payback period. This is per annum. Every year the per. See, I will not make year 1, year 2, year 3. I will not make columns. If the PBDT is different or the depreciation is different, then you should make column wise. Then every year's PBT will be different. Are you understanding what I am saying? You should have that intuitions. You should understand the sum when you check it, when you see it. Acha, PBDT is same. Depreciation is straight line, means every year's depreciation is same. No need to do it 5 times. You can do it vertical method. I call this as vertical method. Is that clear? Same sum, same sum. If they say depreciation is WDV method, then will the annual cash flow every year it will be same? No, because PBDT can be same, but every year's depreciation will be different, right? So if every year's depreciation is different, PBDT minus depreciation every year's PBT is different. Every year's tax will be different. Every year's PAT will be different. When you add every year's different depreciation, you will get different annual cash flow. So you'll have to make a table. You'll have to make a table. This method I call vertical method. And when the PBDT or the depreciation is different, I call it table method. Okay, just for our reference, so that we will be comfortable. Computation of payback period. What is the formula? Payback period. What is the formula? Original investment. See, what is the logic? Sir, you gave us the formula. What is the logic? Original investment is 10 lakhs. Original investment is 10 lakhs. Every year, I will recover 3 lakh 80,000. How much I will recover? 3 lakh 80,000. Correct now? So, how much time it will take? Simple cross multiplication. There is no rocket science behind the formula. Original investment divided by ACF. That is, original investment is 10 lakhs. Divided by 3 lakh 80,000. Everybody, are you understanding? Correct? 10 lakh divided by 3 lakh 80. How much? 2.63 years. Okay, 2.63 years. Right now? Say how much? 2.63? 15 years. Okay, great. Listen. So if I want to write this in months, 2 years and how many months? 0.6 into 12. Very good. Don't say 6 months. 0.6315 into 12. 0.6315 into 12. Because this is year. In a year, in 1 year, there are 12 months. So 0.6315 years means how many months? Cross multiplication. School level maths. How much it is? Yes, 2 years, 7.5 months, 7.5 months. So if I say 2 years, okay, can I say 2 years, 7 month and 5 days? Can 15 days? Why? Yeah, 0. Not 5 days. It is 0.5. Yeah, 0.5 into 30 will be 15 days. I hope everybody is understanding. 1 month has 1 month has 30 days. 1 month has 30 days. So 0.5 month has 15 days. Those who are good at maths, for them. Is it clear? Okay. So this is the way to do. See, there is no rocket science behind the formula. What we did, original investment, how much I invested? 10 lakhs divided by 3,80,000. Divided by 3,80,000. Every year I am going to get 3,80,000. So 3,80,000 plus 3,80,000. I think how much 3,80,000 and plus 3,80,000? 7,60,000. 7,60,000. 760 plus 3,80,000 plus 3,80,000 means the time should be between 2 and 3 years. If you can understand, the time of recovery should be between 2 and 3 years. That is what we have got. 2 years, 7 months and 15 days. Is it clear? Okay. So this is very simple thing. Okay. So write this, copy this. Everybody, I hope now it is clear why we are calculating ACF. Copy this. Have you copied the question? Okay. Copy the solution. Working note number 1 done. Everybody, if you have not, please do it. Yes, say. What is the meaning of the payback period? What is the meaning of the payback period? Can anybody tell me? Great. So I haven't given you the definition, right, for payback. So I missed it. I will give you the definition after this sum. Please write this. Done. Anybody who is left out? Shall we proceed? Okay. Completed, na? Okay, okay. Listen. Right. Payback period means the period when the original investment when the original investment gets recovered when the original investment gets recovered. Payback period means the period when the original investments get recovered. Now it should be clear. So this much time I will take to recover my original investment. Yes, it's an estimation. He is asking whether it's an estimation. Yes, the chapter's second name, other than investment decision, what we can give the chapter's name is capital budgeting. And when I say budgeting, it means I am estimating something. All this is estimation. What we are doing here, company is estimating how much time it will take to recover. This definition I made you write, but actually I have given it in your book. I thought by the way of example we will be able to understand, but someone asked me what is payback period, so I made you write. Next, right, basis of decision. Note number 1. Management decides cutoff period. Management decides cutoff period. Second basis is choose the investment with shorter payback period. Choose the investment with shorter payback period. Let me explain this. See, in one of the exam, what happened is there were two projects, A and B. Okay. Now let's say A has a payback period of let's say A has a payback period of 2 years and here it is 3 years. Okay. So what happens is 2 years and 3 years, correct? So now what happens is if the management has decided that 2.5 year is the cutoff, means you should not accept the project which has a payback period more than 2.5 years. Okay. So will B be selected? No. You will select which project? A. Yes or no? Correct now. If nothing is mentioned in the question, then you should choose the project with the shorter period. Between A and B, which has a shorter payback period? Second, what is the logic behind this? Understand why I will choose A project rather than B. I will tell you, because project A will give me cashback earlier than project B. What I can do with that project, with that cash flow, I can reinvest it and again I can get the cash flow. So which project is better? A. Why? Because payback is faster. Are you understanding the logic behind the second one? Choose the investment with a shorter payback period. When you choose the project with the shorter payback, you get the cash flows early. So you invest it again. Okay, any question on this? Yeah, please say. He is asking me when the cash flows are different, what to do. If cash flows for both are different, at that time also you follow the same rule. For payback period, I am saying. For payback period, please remember, I am not talking about any. Cash flows will be different only for both the projects. Cash flow will not be same. Your question should have been, if the original investments are different, then what should be the the decision? That is the right question. Cash flows though will be different only. Cash flows can't be same na for both the projects. Is it clear? Original investment can be. You mean that only. Original investment if it is different. If original investment is different na, then we will. Then here the decision is same because we have not done other methods. Everywhere the parameters are different. The decision will be on different basis. But payback period, the simple thing, what you will do is you will choose with the investment with the shorter payback period, or you should, if the in the question it is given management decides the cutoff period of this, then whichever is earlier than the cutoff period, that you will choose. If management has said 2.5 years, then you will choose all the projects which are paying you before 2.5 years. Is that clear? Okay. Okay. Payback period is very simple. Okay, very easiest method. The advantage is that what it is simple. Fine. So why I made you write this, because this is very conceptual part, and you have to be, means they will test you on this. They will not ask only payback period. Payback period they know. A CA inter student who has done so much of FM, he will be able to solve. But what they will do, they will give you two projects. They will give you management's cutoff. Okay, and then they will ask which project to be selected. We will do one type of sum on this. Okay, now I am moving ahead. We'll do one type of sum later. Done. Now write one more. Before that, do one thing. Come to the textbook. Coming to the textbook. See, this is what I have given you. Let us read it. Just I am going through it. Okay. Capital budgeting is a technique that helps taking long-term investment decision. That is what I said. Fixed asset is what? Long-term. So we are deciding about that. Long-term investment decision require relevant and correct information before it is taken. See, both decisions are important, whether it is long-term or whether it is short-term. Now, long-term decisions can be corrected. Okay, but it will hurt you in the long term. If the decisions go wrong, it will hurt you badly. Capital budgeting now provides relevant information calculation that are required to arrive at a correct long-term investment decision. So we are going to learn here about the information and the calculation. That is what we did. Capital budgeting comprises of different bases for decision making. Those techniques are as I have given, 8 techniques and 1 MIRR. Right? This is the same thing what I made you write. Payback period. Now, payback period I have already given you what is payback period, correct? It is this method has a clear objective as to in how many years, please understand, in how many years the project asset would pay back the initial investment or initial outlay. This method gives more significance to the cash generating capacity. See, it is clearly given. Now understand, in the calculation, what was involved? Please answer me. I want answer from you people. What was involved? Whether we decided on the basis of cash flow or whether we decide on the basis of profit. Tell me. Cash flow. We divided the original investment on the basis of the cash flow. So this method now, it uses cash flow. I don't know why, but institute now they are focusing more on this. Means they are asking such type of questions in the exam. And very simple 1 mark question. So they want to test you on, because FM doesn't have MCQs now. So they want you to be thorough with the concepts. So they will be asking this. Which of the method means profitability, true or false or something like that. I will check in once the chapter gets over now. There are ICI questions. If you go to that, you will get these questions. We will go to it. But before that, have you understood this? That this method is based on cash flow and not on profitability. Okay, I want you to do that example there. Those who don't have textbook, you have to do it in your notebook. Please complete this example. Yeah, example. This is your original cost of the project. This is your cash flow, 4 lakhs. 3 years, very good. Payback period is equals to original investment upon ACF, annual cash flow. So 12 lakhs divided by 3 lakhs, sorry, 4 lakhs. Answer is 3 years. Done? Okay. Try question number 1. Try question number 1 if you can do it. Let us try to solve this. Please help me. Everybody has the question right. The cost of the project is rupees 40 lakhs. Life is 10 years. Profit before PBDT is rupees 10 lakhs per annum. Rate of tax is 40%. Scrap value at the end is nil. Calculate payback period. Okay. So let us try this. I don't know the answer. Question number 1. First step, working note number 1 should be calculation of depreciation. Straight line method if nothing is mentioned. Original cost is how much? 10 lakhs. 40 lakhs. Be careful. Some people take PBDT instead of this original cost. Salvage value is how much? 0. Life is how much? 10. So depreciation is 4 lakhs. Correct? Working note number 2. Calculation of annual cash flow. Right? Because I want annual cash flow. See how I am solving. When you solve like this now, the examiner comes to know that you are confident about the sum. Go stepwise. Annual cash flow. How I will solve? Every year the PBDT is same. Correct? Every year the depreciation is same. So vertical method. Year 1 to 10. PBDT. How much was PBDT? 10 lakhs. Correct? Minus depreciation is how much? 4 lakhs. Right? PPT is 6 lakhs. Good. How much is the tax? 40%, that is 2 lakh. 2 lakh 40,000. Great. This is the tax. So how much is the profit after tax? 3 lakh 60,000. 7 lakh. What you are saying, man? Acha, okay. He's ahead of us. After adding depreciation, he is saying. So depreciation is 4 lakhs. So total is 7 lakh 60,000 is ACF. Correct? Annual cash flow. Great. See, it is easy. Working note number 3. Calculation of payback period. Yes. Very good. Payback period is equals to original investment divided by ACF. Original investment is 40 lakhs divided by 7,60,000. Answer 5.5 year 3 months. Someone said 3 or 4 year or something. 5 year 3 months something. Give me the decimal answer. 5 point how much? 5.26 years. Then you can convert this into month and all. Okay, fine. Is it clear? Easy? Understood? Okay. Please, those who have not done, please copy. Those who have not done, it will hardly take 2 minutes. Please copy. Yeah, someone has a query? Okay. Please copy this. Done. Okay, we will continue later. Okay.